Hey everyone. The conflict in Iran has created additional uncertainty for the US economy and potentially for commercial real estate investors. In a nutshell, the military action is disrupting the flow of oil and natural gas to global markets. These commodities travel by ship through the Strait of Hormuz, which has effectively been blockaded. And as a result, about 20% of the world's oil and liquid natural gas have been cut off. In addition, the blockade disrupts other key commodities. An estimated 15% of the world's exported aluminum transits the Strait of Hormuz, and about 1/3 of global fertilizer trade also navigates the corridor. As a result, the prices of these commodities have risen dramatically, and they fluctuate on a day-to-day or even hour-by-hour basis. West Texas Intermediate crude oil peaked at $119 per barrel on March 9th. But it has settled into the high $80 range following President Trump's suggestion that the conflict could soon end. In addition, the International Energy Agency announced plans to release 400 million barrels of oil from the strategic oil reserves. To put that release in perspective, approximately 20 million barrels of oil were transiting the Strait of Hormuz per day prior to the military engagement in Iran. Surging energy prices raise headline inflation risk and complicate central bank policy. Higher oil and natural gas prices could put upward pressure on energy and food prices. They could disrupt supply chains, spur tighter financial conditions, and weigh on both business and consumer confidence. That could elevate inflation, increasing the odds of the Federal Reserve keeping rates higher for longer. Prior to the conflict in Iran, Wall Street was predicting the Federal Reserve would cut rates 2 or 3 times this year, but the current outlook suggests the Fed may only make 1 cut this year, or they may decide to keep rates where they are. As a result, bond rates have edged higher, with both the 5-year and 10-year treasuries climbing 20 to 30 basis points since the end of February. The total economic impact for 2026 is difficult to assess at this point. If an off-ramp from the conflict is taken soon and oil begins to flow, the economic consequences should be mild and short-lived. If, however, the military action is prolonged, lasting 3 months or more, it could restrain US GDP growth by roughly 20 to 70 basis points and push inflation into the low to mid 3% range. If the military action lasts more than 3 months and there's substantial damage to the oil infrastructure in the Middle East, the impact could be even more severe. In that scenario, the shock could trim over 100 basis points from US GDP growth this year and push inflation into the 4% range. For commercial real estate, the direct impact on fundamentals will likely be minimal. Industrial properties have the most exposure, as the conflict could negatively impact trade and the transportation of goods, thereby moderating industrial space demand to a degree. Retail properties could also face a marginal reduction in demand, as higher gasoline prices and increased caution weigh on discretionary spending. The impact on apartment and office space demand will likely be minimal and indirect. If business sentiment falls substantively because of the conflict, then hiring could slow further, ultimately weighing on office space and housing demand. But for all 4 property types, the impact will likely be slow to manifest and relatively small. From a commercial real estate investment standpoint, higher interest rates could potentially restrain transaction activity. However, it's also possible that the Middle East conflict could exacerbate stock market volatility, and some investors could seek out hard assets like commercial real estate as a means of diversifying their portfolios and reducing volatility risk. In addition, commercial real estate offers increased inflation resistance, as commercial property leases often have built-in rent escalations, and properties like apartments and self-storage have shorter leases that can mark to market more quickly in a high inflation climate. So while uncertainty and the economic risks created by the conflict in the Middle East could put upward pressure on interest rates and weigh on commercial real estate investment, the conflict could also drive increased capital into the commercial real estate sector, offsetting the restraint of higher rates. Ultimately, the military engagement in Iran is another source of uncertainty for an economy already navigating an unpredictable policy and geopolitical backdrop. And the ensuing economic and financial market volatility reiterates the durability and stability of commercial real estate assets. And that reinforces the value of commercial real estate for investors who keep their eyes on the horizon.